Welcome to the MUFG Global Markets Podcast. I'm Jonathan Wong, an analyst on the MUFG Macro Strategy team, and today I'm joined by our team lead, George Goncalves, Head of U.S. Macro Strategy. It's Tuesday, July 9th, 2024. Hi, George. It's great to have the opportunity to turn the tables now and interview you.
Hi, Jonathan, and it's also great to have you in the host seat.
George, let's review our last monthly special topic, which focused on why it's important to look at data on an inflation-adjusted basis. What are the key takeaways?
Yeah, so we explored in our most recent monthly, which we dubbed The Real Story, exploring inflation-adjusted data. And we set down this path of trying to look at data in real terms where we adjust for inflation. And we found that what has been happening over the last few years is that higher overall nominal activity has made the economy, earnings for companies, and ultimately market valuations look much better than what they truly are. Looking at real data, I think it's important to start off with looking at GDP. And we think of just overall growth usually in nominal terms, but in reality, it should be measured in real terms. And when you look at real growth, there's been moments in history where you can have positive nominal growth, but yet still negative real growth. And those are rare. They happen a lot more often in the 1970s during the high inflationary period. And so I guess there's some parallels to perhaps back then to what's happening now. And then when we went deeper into just overall credit trends and bank lending, in real terms, it has become very apparent that after adjusting for inflation, we've been in an environment that's reducing credit availability to the economy in real terms. And if you then look at overall consumer activity and you measure actual retail sales adjusted for inflation, that has shown that retail sales has actually been growing either negative or very low for over a year now. And so what we find is that real activity is what matters more so than looking at the headlines or top line numbers like are accounting for nominal activity. And the same thing is true even for earnings and equity or bond market valuations. Corporate profits, for example, in real terms, have averaged roughly flat. They've bounced back recently in the last one or two quarters. But in general, since 2022, after a large spike of corporate profits right after the pandemic reopening, we've seen pretty much very little corporate profits in real terms, averaging about zero since 2022. And then if you kind of look at that broken down between large cap and small cap, although large cap companies have maintained pricing power, they've also decelerated. Meanwhile, small cap and smaller firms are really showing very little real pricing power and earnings potential over the last couple of years. And then if you take it to the last natural extension, which is valuations and just performance in both equities and in bond market, we're getting close, but we have yet to really make a new high in either of the large indices when you adjust for inflation, and for the small caps, they haven't, they're still back to like 2018 levels when you adjust for inflation. So inflation matters. It does have the ability to kind of make things look better than what they truly are. The bond market is the one that really suffered the most, which is obviously the bond market's very sensitive to inflation. And when you adjust for inflation, total returns for many different bond sectors are back to levels either in the early 2010s or all the way back to almost GFC levels, erasing both coupon and total return performance for well over a decade. And so, inflation can make things look better, and they have indeed happened that way. We think that we're at this kind of really critical point in the road, that if inflation continues to head lower and both the economy has less earnings power, and then therefore companies themselves will have less earnings power. This means that valuations are probably even more stretched than what are currently being projected. And so, we're going to keep an eye on this this real versus nominal phenomenon going forward, and it's a key topic of ours for the coming months.
Shifting gears, let's wrap up by giving our listeners a preview of what to expect for this week from the macro front.
And so, speaking of inflation, the big highlight on the macro front will be the CPI report, where after Q1 had an anomaly of seasonally higher inflation, it looks like disinflationary trends are coming back on track, and hopefully that means that we will continue to see lower inflation readings or within reason, like a 0.1 on headline and 0.2 on the core is about average. I mean, a little bit lower on the headline side. There's probably some upside risk for headline, but in general, if we get back-to-back months of 0.2s, I think that's a level that would really make the Fed pleased that inflation is in this downward trend. And there is also the risk that something we've been highlighting for quite some time, the big lagged effect of shelter inflation taking much longer to show up in the aggregates. If we were to see a really big catch up and shelter inflations get adjusted lower in this month and as well as in the subsequent months ahead, we don't think now the Fed will cut rates in July, but it would probably really lock in the September cut. A cut in July would probably require a huge miss to the downside on inflation, which I think is not in the cards. But a slight miss, weaker on the core, driven by the shelter, would give the Fed more confidence that inflation's in the right trajectory. And if that were to continue over the course of the summer, I think would pretty much put September in play as almost a foregone conclusion.
Thanks, as always, for your insights, George.
And my pleasure, Jonathan. Thank you. Thanks for hosting.
We would like to remind our listeners, for those that would like to receive George's strategy reports directly, please email your MUFG sales coverage or get in contact with George directly on email or Bloomberg. Thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.